Welcome to this edition of Diligence Inside Today's Boardrooms. I'm TK Kerstetter, and I'll be your host for today's show. You might notice that we have a different background and a different name. And we decided that with companies going global and the fact that we also did shows in Europe and in Australia, we decided to merge that all together into one, which we will now going forward called Inside Today's Boardrooms. So it's still a pleasure to be your host, and it's still a pleasure to bring you some great episodes. And this certainly is one of them, and an important one. Today, we're going to be talking about, is your board prepared for the SEC's pay versus performance disclosure rules? And joining me is an expert in this space, Don Kalfen, who's a partner with Meridian Compensation Partners. Welcome back, Don.
Thank you, TK.
So obviously this is very complex, but we're going to try and break it down a little bit. But let's start by, can you review the events that sort of led up to the SEC mandating the pay for performance, as they call it, PVP? And then maybe more importantly, what is the crux or the core issues of this mandate?
Sure. Thank you, TK. Happy to do so. Well, the genesis of the PVP disclosure stretches back 12 years to the passage of Dodd-Frank. In Dodd-Frank, which primarily is a financial reform bill, tucked in there's a small provision on executive pay and corporate governance. One of those provisions directed the Securities and Exchange Commission to rule with respect to pay versus performance for public companies. The SEC issued proposed rules in 2015, and finally, this last August, issued a final rule on the pay versus performance disclosure. And these rules are enormously complex. I've reviewed some initial PVP disclosures by some of our clients, and they're running some over 6 pages in length. Now, the nature of the pay versus performance disclosure itself is somewhat of a misnomer. Under the rule, companies are required to compare for their executive officers compensation actually paid against 3 specific performance metrics. Now, the term compensation actually paid is simply not true. It's a synthetic amalgam of pay that actually occurred and accounting values for equity awards for fiscal years under examination. The number is no better or worse than the compensation that's disclosed in the summary compensation table, which itself is an amalgam of actual pay and accounting values. Now, the compensation actually paid is to be compared against a company's net income, a company's total shareholder return, and a company's selected performance measure. And this would have to be a financial performance measure, such as earnings growth or revenues or EBITDA. And this is displayed in a multi-column table that frankly borders on the incomprehensible. In addition to the table, companies are required to then describe the relationship between compensation actually paid to its executive officers and these 3 performance metrics. And this could be done in a graphical form or narrative form, or both. I've seen clients take both of these approaches. The graphical approach is perhaps the easiest to understand, but companies obviously are free to choose what makes the most sense in their situation. The disclosures require extensive discussion on how compensation actually paid is calculated, which is a complex calculation, as well as a host of other footnote disclosures explaining various elements of this table. Now, whether anyone will be able to understand what the table provides remains to be seen. We anticipate the table and its related disclosures will be placed towards the rear of the proxy. It does not belong or is not required to be in the CD&A. It's up to each issuer to determine where it should be placed. We imagine most companies will place the PVP disclosure after the CEO pay ratio.
So, yeah, 6 pages to the proxy is not going to make anybody happy. Let's hope that that's not the case. And I can sort of tell you, sitting here, I'm already a little confused. So I anticipate that that's going to be the case for many companies, as you predicted. But it is what it is, and it's something that the boards have to respond to, or more importantly, probably the managements have to respond to and figure out how this is going to work. But probably the next question is, what should boards be doing to prepare to comply with this SEC disclosure rule? What should they be doing today?
Right. No, that's a great question. Well, I think first and foremost, boards and compensation committees need to look at this from a big picture perspective. Management and their advisors really will get into the nuts and bolts of this. But because of the enormous complexity of the rule, it's easy to lose sight of what's trying to be communicated here. So boards and compensation committees need to understand the crux of the disclosure. And as I've discussed, the crux of that disclosure is attempting to show the relationship of this new idea, compensation actually paid, versus these performance metrics over a multi-year period. So that's first and foremost. They need to understand that, and they need to ensure that management is communicating to them in January and February meetings how this will appear in the proxy. What exactly will be the relationship between compensation actually paid and these performance metrics? Next thing committees and boards need to bear in mind is what is the nature of the relationship? Is it strongly correlative? Is there a weak correlation, or is there a fact of disconnect? And that should inform committees and boards whether there should be additional disclosure around the showing of this relationship. That is there a need to be an explanation where there may be a disconnect, why that exists? So these are the type of issues that boards need to wrestle with as they evaluate the nature, the form of this disclosure. The other thing they should bear in mind is how is this going to look to external parties? And here there's some good news. One is we know definitively Glass Lewis and ISS will not be changing their pay for performance evaluations to reflect the SEC's version of pay versus performance evaluation. They're going to keep their current methodologies. Now, they may take into account from a qualitative standpoint this P versus P disclosure, but that's a soft evaluation. Second, institutional shareholders. We don't know definitively how they're going to take this into account, but we believe for the several years, they're going to digest this disclosure and maybe down the road take into account to some degree. Right now, we don't anticipate institutional shareholders are going to give great stock to this disclosure. What remains important and what the board and compensation committee should remain focused on is a CD&A. And that's where the important disclosures are made with respect to pay versus performance. It should already be made. But this could be a good time to look at those and refresh those disclosures to make sure that they are robust, to make sure that they adequately describe the relationship between pay and performance in simple to understand terms, which the PVP disclosure simply does not.
Well, it sounds like when you say to focus on the CD&A, obviously pay for performance is nothing new. We've been talking about that for some time, but again, this is there's not much area to argue. This is a responsibility now that companies have to report, and it's the board's job to oversee and make sure that this gets reported and complies with the SEC disclosure mandate. So, Don, as always, I want to thank you for taking us at least a little bit into the weeds on what we have to worry about relative to this. And I'll be anxious to see how this all pans out as we get through our first proxy season with this required rule. So I want to thank you for taking the time for joining us again.
Sure, of course.
And that will conclude this edition of Diligence Inside Today's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.